Well, hello everybody. Thank you so much for being here. First, I want to let you know why, why am I doing this, right? So, in 2016, I would think like most of you guys. So I would have voted for Hillary Clinton in 2016. But I listened to a lot of podcasts and I read a lot of books. And in one of the podcasts, there was an interview. They were interviewing an economist, and the interviewer said, the economist said, companies, they fail all the time. Like individual companies, they fail all the time. But when a whole sector of the economy, 2 years, I've been just reading books and articles and watching YouTube videos. So I'm not an economist, I'm an engineer. And also when I came to ESADE and I had the global markets class, I was like, I could not deal with it, and I'm doing this more for me than for you, because I need to get this off my chest, and I'm recording this because otherwise my mother would kill me if I didn't record it, because she wants to watch it. So okay, let's go. So the prevalent narrative of the 2008 financial crisis is that it was because of deregulation of the market and because of the greedy bankers that would do predatory lending into low income and poor people. They would trick these poor people into this predatory lending with high interest rates and whatnot. Okay, so what I want to do is I want to push back against this narrative, and I want to explain and tell you how the US government intervention in the economy created the housing bubble and crashed the economy. Well, we will divide it in two. So the first part is going to be the theory, and the second part is going to be like the actual what happened in 2008. So there are many schools of economics. The mainstream economics today is the Keynesian school of economics because of John Maynard Keynes, and the Austrian school of economics is a small but growing community of economists that, these are not new ideas. These are very old ideas, but they're not put into practice for different reasons. So what I'm going to be talking about today in the first part, I'm going to be discussing Hayek's work because of the work that the thesis, of Hayek won the Nobel Prize in 1974. So what I'm about to tell you is not my opinion. It won the Nobel Prize. It's a work that it doesn't get much recognition from mainstream economics, but mostly because they ignore it. It's not that they refute it. Okay. So what are the interest rates? Right? The interest rates are the price of money. Okay. Now, there are two ways that the interest rates can be set, either by the market or by central banks. Today, most of the economies in the world have a central bank. There are very small countries that have no central bank, but for practical purpose, all the countries have central banks. Okay, so today, in most economies, the governments, they get together and they say, okay, this is the interest rate. Right, so it's not a price that is set by the market. Now, let's imagine that there is no central bank, because the central bank in the US was created in 1913, and the central bank in Argentina, for example, in 1935. So these countries existed before central banks. Now, what would go into the price? What would go into the interest rate? What movement makes the interest rates go up or down without a central bank? The interest rate is the price of money, right? So the bigger the pool of loanable funds in the economy, the lower the interest rate. Okay? So the bigger the supply of money that's available for lending, the price goes down. So the interest goes down. If the pool is bigger, it means that the people are saving more money. So you have more money in your bank account, in your savings, and that money gets lent to investors and businessmen who then invest in their businesses. Okay? The bigger the pool, the lower the interest rate. The smaller the pool, the higher the interest rate. Okay? Now, when they go, and actually what Hayek is saying is that the interest rates, they have a purpose in the economy. They coordinate production over time. Okay? So what I'm going to do now, I'm going to let an actual economist explain this. It's a 3-minute video, but it's a synthesis of the thesis. Okay?
And for those of you in the room who are experts who are saying, I can't believe he didn't talk about the... Well, you're right, and I deserve that rebuke, but I'll happily take an extra 15 minutes, but Doug French will never let me speak at one of these again. So please just be patient with me. Let me just give the stripped-down version. It basically goes like this. What Hayek was arguing in his important writing in the 1930s was that interest rates actually play a role in the economy. They're not just arbitrary numbers. They play a coordinating function. And when they are permitted to play this coordinating function, what they do is they coordinate production across time. So that is to say, when we save more and interest rates consequently decline, that is the very time that it makes sense for businesses to produce goods and to engage in projects that are going to bear fruit in the future. Because when we save more, we're basically saying, I'm going to consume this portion of my income in the future. Well, that's the future that businesses are investing for. And why are they investing now? Because the interest rates are low. And the longer term their production project is, the more interest rate sensitive it is. So it's going to give a disproportionate stimulus to longer term types of investments. So the interest rate then coordinates this. My desire to consume in the present versus the future, and businesses' production processes oriented toward the present versus the future. Secondly, the very fact that I'm saving, that I've earned my money and have not returned back into the economy to take that money and claim all the resources to which, in a sense, I'm entitled, I'm actually leaving some of those resources out there in the economy. Well, my deferral of consumption, my releasing of resources into the economy provides the material wherewithal to see all the new business projects undertaken by investors through to completion. So again, now the interest rate is coordinating this as well. In effect, the supply of real saved resources in the economy. And what Hayek said is that when you tamper with the structure of interest rates as the market sets them, you are introducing discoordination into this coordinating structure. So now, if the central bank, like the Federal Reserve, simply says, we're going to force interest rates down through our open market operations, the problem here is that in this case, the public has not necessarily indicated they want to consume in the future. They want to consume right now. They might want to consume even more right now. But yet, businesses are still being encouraged to engage in long-term investment. So people are demanding more of existing goods right now, but yet investors are being misled into engaging in long-term product development for new products in the future. It's a time mismatch. Likewise, if just because Ben Bernanke or Alan Greenspan says, hey, we're going to force interest rates down, that doesn't release any more resources into the economy. So you have an unchanged resource pool to fund a whole bunch of new investment projects. Well, how are you going to do that? They can't all be completed. So there's going to be a bust that comes. So this is the super duper, really fast overview of this. So that's why simply saying, let's create more money and let's jolt that money into the banking system and keep interest rates down, that's not a solution to a depression. That's the cause of a depression. That's what gets people onto these unsustainable investment trajectories. And if you continue to do it, all you're doing is encouraging people to continue building things that ultimately can't be finished, or won't be profitable, or there won't be sufficient consumer demand to in effect, rationalize these investments at the end. So that's a super duper duper stripped down version of the...
Okay, so you see there's a time mismatch here, because the signal that if the interest rate is low, it signals businesses that people have money in their savings account and they're going to consume in the future. But that's not the case. The fact that the central banks prints money and gives it to the banks so that they can lend it doesn't mean that the people have money in their accounts to consume the products that these companies are investing in producing. You see, so there's a time mismatch, and that's the root of the boom-bust cycle. Okay, that's at the heart of it. So the central banks cause the boom-bust cycle. Okay, so going a little bit into 2008, we can see here the year 2000. You remember the dot-com bubble. Okay, so instead of going to housing like they went in 2008 and before, the money went into tech companies. Okay, but it's the same mechanism, but just that the money went elsewhere. Okay, but it's the same thing. So here, dot-com bubble, Bush enters, Alan Greenspan was the chairman of the Fed, and Bush, he didn't want a recession because Bill Clinton didn't have a recession, and recessions are politically, they're not good. So what did he do? He lowered the interest rate. So again, same thing, just lowering the interest rate by printing money and giving it to the banks so that they can lend it to the people, and then the bust comes. Okay, so that's what happened before 2008. And I'm sorry, this is the federal funds target rate. There are many interest rates in the economy, but all of them are based on this one. Like all of them are influenced by this one, and this is the rate that is set by the Fed. That is at the rate at which the banks lend to each other. Okay, all of the other interest rates in the economy are influenced by this. Okay, and between 2000 and 2007, the Fed printed more money than in all the history of the Republic. Now, that's why the bubble was so big. The dot-com bubble was not so big because the amount of money that the government printed was not so big. I mean, the bigger the amount of money they print, the bigger the bust, the bigger the bubble. Okay? Now, as Tom Wood said, this money, that when the interest rates are at 1%, the money goes into more capital intensive projects. So which is oil rigs, mining, construction. You see, construction, housing, that's a capital good. That's a capital intensive part of the economy. Okay? So that's one of the reasons the money went over there. Due to government pressures, threats with lawsuits and incentives, the excess in the money supply went into real estate. Okay, and I'm gonna when I say this to people, they're like, I'm not sure the banks, the government did this. I'm gonna prove it. Okay. Now look at the house prices. We can see that. Do you see the bubble being formed? Do you see here the big pump, as it's called? It started in 1995 by Bill Clinton. It started putting money in the economy, but then Alan Greenspan run it up here, and all this money went into the housing, and so there was so much demand for housing that's what makes the prices go up. You know, the demand, the surge in the demand makes the prices go up. Okay. Now another thing about having low interest rates is that the people are disincentivized into saving. So if you have money, you don't want to put it in your bank if it gives you 1% return. You want to spend it, right? So the economy is pushed into two opposite things at the same time. People are spending a lot because there is no return on their money, and the companies are investing a lot because they think there's a lot of money in people's accounts. So we have a stretch of the economy. You see the real savings here, 2008, 2006, 2006, 2007. You see that the people have very few money in their accounts. Okay, so that they cannot buy things. And what the Austrians always say about this is that the boom is an artificial boom. Okay, the damage to the economy is done during the boom, which is all these unsustainable projects that are being started and are being invested in. This is like a sugar high, or when you take drugs, like when you inject like heroin or whatever. Not that I've done this before, but you get a high. You feel good, right? but eventually the reckoning is going to happen, and that's the bust. Okay, the bust is the economy's way of trying to go back to health. It's, again, with the drugs. If you inject, okay, you don't want to go back to reality because you're gonna have depression. So you just can keep hitting, but if you want to go back to health, you need to withdraw. You need to stop taking your drugs, and that would take pain, and gonna have withdrawal symptoms. So, but it's the only way you can go back to health. Okay. Now the summary of the theory: central banks hold interest rate low. The bank extended credit. Business overinvest. Okay. Not overinvest, but also malinvest. So in other sectors of the economy. Unsustainable boom period and severe bust period. This is the Mises, Ludwig von Mises always uses this analogy. It's a house builder analogy. So we have this house builder that he's misled into thinking that he has more bricks than he actually has. So he goes to his warehouse and he counts, okay, I have 100. But in reality he has 50, okay? So with 50 big bricks, he could build a 50 square meter house, okay? With 100 bricks, he could build a 100 square meter house. But he thinks he has 100 when he has 50. Okay, so he starts building the 100 square meter house, right? The longer, I mean, the later he knows, he understands that he has only 50, the worse is going to be. The more squashed resources are going to happen, you know. So the earlier he knows, the earlier he's gonna reroute or do whatever with his bricks. Okay. So what's the difference between mainstream Keynesian versus Austrians? Keynesian states that the business cycle is a fundamental feature of the economy caused by human animal spirits. That's what Keynes writes in his book in 1936, the general theory of interest, money, and whatever. And they also say that government can lessen the effect of the business cycle through fiscal and monetary policy. And the Austrians say that the business cycle is caused by the government by lowering interest rates, and government intervention worsens recessions. With a free market interest rate, the business cycle would not occur. Does anybody have any question on the theory?
Print money and do lower interest rates.
Because they want to stimulate demand. That's what they say. They go, because according to Keynesian economy, how do countries grow? By spending. You know, that's what we always hear. So, go out and shop. You know, Bush said after 9/11. Okay? So that's what they do. They want to stimulate demand, so they lower interest rates, so people can spend. Okay? Alright, so we go to the second part. How the government intervention created the housing bubble. I'm gonna do some concepts here. Alan Greenspan is the Fed chairman. Okay, he's one of the guiltiest guys in the 2008 crisis. What's moral hazard? In economics, moral hazard occurs when someone increases their exposure to risk when insured, especially when a person takes more risks because someone else bears the cost. So you invest, and if that investment turns out good, you make money. But if it turns out bad, someone else bears the cost. Okay, that's moral hazard, and we're gonna see a lot of this. Fannie Mae and Freddie Mac. I'm sure you all heard these names, but what do they actually are? What are they? Fannie Mae, Federal National Mortgage Association, created by FDR in 1938. Fannie Mae stimulates home ownership and expands the liquidity of the mortgage market. Okay, so that's government right there. That's not a free market institution. Freddie Mac, Federal Home Loan Mortgage Association. created in 1970 to expand the secondary market for mortgages in the US. So what they buy mortgages on the secondary market, they pool them, and they sell them to investors in Wall Street. Okay, that's what they do. And they're what is called GSE, so a government-sponsored enterprise. Look at the size of these things. I mean, people say, oh, they're not that big, whatever. Fannie Mae is the biggest company in the US by total assets. And Freddie Mac is fourth. Between the two of them, it's 5 billion and whatever in assets. And the stars there, it means that they're government-sponsored enterprises. What are adjustable rate mortgages? They're mortgages, okay, but they begin with a teaser rate. So they would say like, for the first year you would pay only 2%. But nobody knows what is actually the rate later when it resets. It could be higher or it could be lower. Okay, so they start with a teaser rate and then the real rate kicks on at some point. Who are the culprits? So who are the guilty people in the 2008 crisis? So we have 6. Fannie Mae, Freddie Mac, and the rating agencies. CRA and affirmative action lending. CRA means Community Reinvestment Act. Third, the government artificial stimulus to speculation. Fourth, the pro-ownership tax code. 5, the Fed and artificially cheap credit. And 6, the too big to fail mentality. Fannie and Freddie. So, what do they actually do? How did the money move? Okay, so the government creates it. Okay, the government creates the money now, and they give it to the lending institutions. The lending institutions are not only banks. There are many institutions that only do mortgages, like Countrywide or I don't know, something else, but it's institutions that they're not banks, but they do mortgages. Okay, so lending institutions. So the government gives the money to them. Then the government forces them to give it to you. Okay. All right. So they give the mortgage to you. So they have the mortgage in their books. So now you're making the payments to them. Okay. But these guys, they sell them to them. So now the mortgage, your mortgage, they don't care about it because you're making the payments to Fannie and Freddie. Okay? And Fannie and Freddie, what they do, they pull them. So here you have 1, here you have 2. They make 2, or they pull them together, and they sell them in the open market to Wall Street investors. Okay?
Just quickly, when you say the government forces the lending institutions to give you the mortgage, what do you mean by forces?
Yeah, I'm gonna. Okay, but why were these guys buying all these mortgages?
AAA rating.
Exactly. We have the rating agencies. So these mortgages that most people didn't even know what were in them, they were rated AAA by the rating agencies. Now why? Okay, so this is the movement of the money. Okay, this is the secondary market of mortgages, and this is the first one. This is how the money moves. Okay, Fannie and Freddie had 75% of all new mortgages in the U.S. When they say new, I don't know what they mean. 2 years, 3 years, 5 years. Okay, but they had 50% of all mortgages in the U.S. 50%. Now imagine that number. So these guys are huge. They're immense. Okay, and the diversion of resources into the housing market is what inflates home prices, because they're diverting the money, all the money into housing. So more demand for housing, the prices go up. This guy is Peter Schiff. He is an investor. You're gonna hear a lot more about him. Not today, but yeah. So the point I'm trying to make here is that Fannie and Freddie are government institutions, okay? It's the government putting their hand in the housing market, okay?
Now, I happened to watch an interview on CNBC a few years back with the outgoing head of Fannie Mae. And he was still there at the time, and it was towards the end of the housing bubble, like 2007-ish or so. And they were changing their standards. And he said that we're changing our standards on ARMs, okay, going forward, right? And it was going to start in several months. And they said, going forward, we will only approve mortgages where the people can actually pay the money back, right? They said prior to that, if you took out an ARM, Fannie Mae would guarantee the mortgage as long as you could pay the initial teaser rate, even though they knew that you couldn't possibly pay the rate that it would reset to. Yet the government was knowingly guaranteeing those mortgages. And the interviewer said, well, what do you mean? Why were you letting people buy houses you knew they couldn't afford and you knew they would default? And they said, well, the thing was, everybody was getting rich buying real estate, and we didn't want to deny people that opportunity. This is the head of Fannie Mae saying, we put a US government guarantee. We let people knowingly buy houses and commit to mortgages that we knew would default, and we guaranteed them anyway, because we didn't want to rain on the parade. That was the government. That was the government. And then finally, after the fact, that
okay, so I have this. There's a CNBC article here. I'm gonna read some quotes here. Daniel Mudd, he was the chairman of Fannie Mae when everything happened. Quote, Fannie Mae faced the danger that the market would pass us by, he said. We were afraid that lenders would be selling products we weren't buying, and Congress would feel like we weren't fulfilling our mission. The market was changing, and it's our job to buy loans, so we had to change as well. So, what kind of company would say, it's our job to buy whatever? The job of the companies is to sell something, it's not to buy. Why would you buy something only for buying, you know? Second, the same year he took position, regulators sharply increased Fannie Mae's affordable housing goals. Democratic lawmakers demanded that the company buy more loans that have been made to low-income and minority homebuyers. Quote, when homes are doubling in price every 6 years and incomes are increasing by a mere 1% a year, Fannie's mission is of paramount importance. Senator Jack Reed, the Rhode Island Democrat. So, and there are a lot of people that say, oh, the regulators, they didn't do their job, The regulators are the ones sharply increasing Fannie's affordable house goals. So, the regulators are regulating very good, but they're doing the wrong thing, but they're actually doing the job. Quote, we didn't really know what we were buying, said Mark Gott, a former director in Fannie's loan servicing department. This system was designed for plain vanilla loans, and we were trying to push chocolate sundaes through the gears. Another quote, everybody understood that we were now buying loans that we would have previously rejected, and that the models were telling us that we were charging way too little. But our mandate was to stay relevant and to serve low-income borrowers. So that's what we did. Okay? And last one, it is a political organization by design. The company's charter gives the president the right to appoint 5 of the board's 18 members. The idea was to ensure that Fannie fulfilled its public mission. Okay? So, government, right here. CRA and affirmative action lending. Now I'm going to your point, okay? CRA, the Community Reinvestment Act, is a federal law enacted in 1977 to encourage depository institutions to meet the credit needs of low and moderate income neighborhoods. The CRA requires federal regulators to assess how well each bank fulfills its obligations to these communities. Okay? It was created by Jimmy Carter, but given new life by the Bill Clinton administration. Okay, so this act was making the banks, forcing the banks to make loans that they wouldn't have made otherwise. Okay, and this is my favorite video. Andrew Cuomo, he's now the governor of New York, who served as Housing and Urban Development Secretary under Bill Clinton, spoke with delight after a victorious discrimination settlement with Acu Bank mortgage that forced it to make loans on what the secretary admitted was an affirmative action basis. 2.1 billion in loans of this settlement.
to take a greater risk on these mortgages? Yes. To give families mortgages who they would not have given otherwise? Yes.
Get the loans at all. They wouldn't have.
They would not have qualified but for this affirmative action on the part of the bank, yes.
What is the representative of that low and moderate income group?
It is by income and is also by minorities, yes. With the 2.1 billion lending that amount in mortgages, which will be a higher risk, and I'm sure there'll be a higher default rate on those mortgages than on the rest of the portfolio.
Okay, so there is no doubt that the government was forcing the banks into making this loan. Okay, but it was not, these were like 15,000 loans. It was not these loans that make the economy crash. But with this settlement, the government sent a message to the banks that if you don't comply, we're going to come for you. And there was another senator that sued Citibank, this exact same thing, and then the name, the senator's name is Barack Obama. Third, government artificial stimulus to speculation. Although they're driving, because they're relaxing their lending standards, okay? The government is forcing the banks to relax their lending standards. Although behind abandoning traditional lending standards was the federal government's political goal of increasing home ownership among preferred minority groups, lending innovations like 100% loans, mortgages with no down payments, became institutional features of the industry, particularly when the Fed had made banks flush with reserves to lend. Dream Down Payment Act of 2003, signed by President Bush. As part of Bush's ongoing effort to help American families achieve the dream of home ownership, Commissioner whatever announced the HUDs proposing a zero down payment mortgage, the most significant initiative by the Federal Housing Administration in over a decade. This action will help remove the greatest barrier facing first-time home buyers, the lack of funds for a down payment on a mortgage. So, the government is relaxing lending standards to increase home ownership because they think it's a good thing. Okay, so you would have qualified for a loan, for a mortgage, but because of the government, now you do. Okay, so the default risk goes up, like balloons. Okay, now this everybody talks about the subprime loans, but this relaxation of standards didn't go only into subprime loans. It infected the prime loans as well. In the prime loan market, from 2006 to 2007, the increase in foreclosures started much higher in the case of prime loans than in the case of subprime loans. Okay, so it's not only the subprime market. Actually, the damage in the prime market was bigger. It turns out that there was a larger percentage increase in adjustable rate prime mortgages than there was in subprime mortgages, where all the trouble was said to be. So when these ARMs, these adjustable rate mortgages, kicked in, the percentage increase in prime was more than in subprime. Now, there are two types of speculators. The guys who flip houses, so you buy, you remodel, you sell, or you buy, you live, you wait, the house appreciates, and then you sell, okay? So in recent years, speculative home buying has been estimated at about 1/4 of all home purchases. 25% of home purchases were speculation. And both kinds of speculations were attracted to this because of the teaser rate, because of the adjustable rate mortgages, because they thought that they were going to unload the house, so sell the house, before the teaser rate expires. There was a survey made in California that in 2005, the average home buyer in California thought that their house would appreciate 20% a year, every year, for 10 years. So if you took a $500,000 mortgage on a house, in 10 years you were going to make $3 million. So that was what the average home buyer thought in California. Now, is it any surprise that people gamble when they have nothing to lose? So you don't even have to put down a payment, a 20% payment. You don't have to do anything. So, but these guys actually believe that if they bought the house, they would make $3 million over the next 10 years. Is it any wonder they signed up for a teaser rate? Do you think they cared what happened to the loan 2, 3, or 5 years from now? They didn't care what the resale was. They were going to be rich. All they had to do was buy the house, and they were going to be rich. In fact, if you figure what the average Californian expected to earn on house appreciation, it exceeded what he expected to earn from his job. So it used to be that you work hard and you save money to buy a house, and now you buy a house so you don't have to work. That's the bubble mentality. Okay. Now with mortgages, because they are an SEC is Securities and Exchange Commission, they're a cartel basically. You cannot open a rating agency. You need to be approved by the government. So there's no free market over there. There's no free competition. It's not like I can open one and, oh, these mortgages, they look fishy, I'm gonna put a BBB or whatever, C+, okay? No, you cannot, because the only ratings that are approved by government are only 3 companies, Fitch, S&P, and Moody's. Okay? So it might be objected that these agencies would not want to create political waves by rocking the mortgage boat, endangering a potential loss of their protected profits. Government again. COVID 4, this I'm going to be really quick. So the government was incentivizing you to borrow money and buy, not to rent, and not even if you had your money, not buy the house with your cash. Because if you bought it with cash, with your cash, and then you sold the house, you would have to pay capital gains tax of 15%. If you borrow the money and then you sell, you don't have to pay this tax. So they were incentivizing people to borrow and to buy, not to save or to rent. The Fed, all of these corporates, yeah, they're guilty, but none of this would have happened without the Fed lowering the interest rates. Okay? I'm going to read this. Pretext aside, the Federal Reserve System is for all intents and purposes an arm of the federal government. Created by an act of Congress, its chairman chosen by government appointment and endowed with monopoly privileges, the Fed rests on principles diametrically opposed to those of the free market. It is dedicated to central economic planning, the great discredited idea of the 20th century. Except instead of planning the production of steel and concrete, it plans the production of money and interest rates, with consequences that necessarily reverberate throughout the economy. Okay? So this is central economic planning. Corporate 6, too big to fail mentality. Greenspan put, this is what something that was known in the market. A put option or a put gives a buyer the right to sell an asset at a given price. So you buy a stock at $10 and you buy a put option at 7. So if the stock goes to 3, you can sell at 7 anyways, okay? Because you bought the put option. Now the suggestion is that just in traditional put, the figurative Greenspan put places a floor beneath asset prices. In Greenspan, the Fed will prop up these troubled assets if necessary. A couple of quotes. This is Ernst & Young economist. Since Alan Greenspan took office, financial markets in the US have operated under a quasi-official charter which says that the central bank will protect its major actors from the risk of bankruptcy. Consequently, the reasoning emerged that when you succeed, you will earn high profits and market share, and if you should fail, the authorities will serve you anyway with taxpayer money. That's the moral hazard that I was talking about. Private profit, socialized cost. Financial Times, when markets unravel, count on the Federal Reserve and its chairman Alan Greenspan to come to the rescue. That's it.
The question, you named 6 institutions that are responsible for this, but don't you think that the people are also responsible? If I offer you heroin, you don't have to take it. If you take it, you're gonna be in trouble. But people should know this. If I earn a little, if the salary is very little, and if I take a loan for, I don't know, for $500,000, I'm not gonna pay it back.
If I give you free money, if I give you a house and you don't have to do anything,
You will still end up in private bankruptcy.
but you thought that your house was gonna appreciate. You thought that, okay, I'm going to the bank, they give me $500,000. I mean, they give me a house, and I just wait 2 years and I sell it.
But this is like 20% increase every year. It's like kind of, it's unrealistic.
Yeah, I mean the people were, thanks. The people were, there was so much money, and your friends and your family were getting rich because they were buying houses and they were selling them. And you don't want to be rich, you know? So I might just go to the bank at the corner and ask for a mortgage because all these people are getting rich. Why not me?
With loans, yeah.
With loans,
Yeah.
you know? Why not me? I want in too.
And it's still risky. I mean, I definitely get your point, and all of the 6 you mentioned definitely responsible for this. But I also see, as a 7th option, I see also the people.
So the people who
charge.
So for example, there was an example in the book. This guy, he was making $70,000 a year, and he had a girlfriend that she was between jobs. So, and he qualified for a $500,000 loan. And why wouldn't he take it? I'm giving you a house for free. You don't have to put down payment or whatever. You know, and this thing, the bubble, nobody knows. Look, so if you see the quotes by Paulson or Greenspan or whatever, they say, or in 2008, like in March, our financial institutions are strong. Our housing market is better than ever. You should see. I'm gonna give another talk, okay? This guy Peter Schiff, the guy who said about the interview, he made several interviews in NBC in 2006, 2007, and he was saying that this was going to happen, and they were laughing at him, like on TV. I'm going to show you, like in the other day. But yeah, nobody knew this was happening, and you had nothing, and the bank wants to give you a house. Okay.
But you knew what you're gonna have to. You knew that you have to pay it back, and you knew what the rates are gonna be. You closed your eyes at the beginning, said, I'm gonna earn money when I sell the house. But you knew in the next 10 years before I can sell it, I have to pay the money. And they had money to people which had an annual income worth, let's just say, $25,000 US. And they knew they have to pay like $800 a month back. It's impossible.
They didn't know. Most of them didn't even understand.
They didn't calculate.
The target, the teaser rate. They didn't even understand, and most of them thought that they were going to sell their houses before the interest rates, the real interest rate sets in, you know. So, and if I can ask for whatever if they give it to me, but the problem is that the banks were giving it to you. So like, the banks suddenly, like JP Morgan, these guys have been in business for more than 100 years, and now they don't know how to evaluate people based on credit. They just give loans to everybody, you know. So it's the government forcing the banks into giving loans that they knew that we're not going to back, not going to get back. What else? Okay. Yeah.
What was the teaser rate and what was the actual rate that would?
I don't know, but it was substantially lower.
Okay.
Yeah.
And is the AIG thing related to this because they insured the housing loans, right?
Some of the loans were insured by AIG.
Yeah. Okay.
So that's why they went under. I mean, they didn't went under because the government said that.
With AIG, they were doing a lot of credit defaults.
Yeah, also.
So they securitized the loans.
Actually, there was a betting also on the securities, like the repayment was going to happen, so people were kind of. There was a third market for it, like futures and options.
Yeah, then it started going like. But that was like more at the end.
Yeah.
When the banks bet that your loan will default, right? So they gave you money, and then as soon as you left the room, they put money on you. You're not paying it back.
Yeah.
I mean, most of that was at the end, like at the very end.
Yeah.
But most of the loans, they were making it to you because they knew that Fannie and Freddie would buy them. you know,
Yeah.
And sell it to.
and then bundle and sell them to the investors. Yeah.
So, Maxi, thanks. Really good.
Thank you.
I'm sorry I walked in late. I
Alright.
actually thought it was 3. I thought it was earlier.
Oh, no worry.
So, like, it's really clear how you diagnose the problem and how that could lead to like a bubble. It's clear that all these like extra cash and all these things will create something like that. But just on the flip side of that, how do you what these loans were doing was bringing people into the economy that otherwise would be left out of the economy. So if you have a house, just bear with me. If you have a house, it means that you have collateral for a loan, which means you can start your own business. Like, that's the theory behind it. And I'm not talking about like the ninjas, people who shouldn't have ever qualified for a rate. I'm talking about the people who are like just on the borderline. But now you're bringing these people into the economy and potentially they can start businesses, especially if they own a house because they have collateral for a house. So do you think there's like a balance where you can have these sort of institutions bringing more people into the economy? Because otherwise the potential reality is that if you don't do that, you're only really serving like the 5% of people who can afford all of these things.
Well, the first thing is that, first of all, you have in order to do that, the government has to initiate, like, the government has to force the banks to do that. Because if you lend at 3% interest rate, okay, and one loan is bad, that one loan, if I lend to all of you, okay, at 3%, let's imagine we're 30 people here, at 3% interest rate to everybody. If one of you, if Alvaro doesn't pay me,
He never pays.
he pays me zero. He pays me zero. I need all of you to pay me everything to break even. You know, so one bad loan equals 29 good loans. So the banks have to be very careful into who they're lending the money to, and who is Greenspan to be playing with other people's money. You know, they're forcing the banks to make loans. And I'm sorry, the first part of the question was the balance, right? Okay, so who made money in this boom and who lost money? This guy who was making $70,000 and his girlfriend was between jobs, he lost a lot of money. He was indebted. He didn't have a house. He was a lot worse when he finished than when he started. Okay? And who made money? The realtors, the developers, the speculators, the guys who flip houses, the bankers. This is the people who made the money in the boom. And the people that these policies were supposed to help, they ended up a lot worse than when they started. Yeah.
Yeah, I think that it's a good point, and go towards like because after all, there was no free market because when these banks they went bankrupt, the government went and
the bailout
and
yeah.
financed that.
That's the moral hazard.
Yes, but like after all, who really lost money was
the taxpayer.
Exactly.
Yeah.
Exactly. So like it doesn't mean that interviewing in the market you bring people you
out.
give access to them, you know, because you are also contributing to a not stable environment, you know. I don't know. That's
yeah.
what I
yeah.
I have something to add to Joe's comment. So in India, you have a lot of people who don't have houses. So there's this low income group, and what the government is doing is basically taking the taxpayers' money and giving it directly to these people, like directly to their bank account. They are not through financial institutions or anything. It's like pretty much transparent. You get the money, you build your house, you send a picture, the government approval comes to your premises, they take a picture, they upload it to the government database, and then they get the second tranche of money when the second floor or whatever the progress of the construction is. So this is like directly transferring taxpayers' money to poor, but you take out like everything. Yeah, so I don't know if it's right or wrong, but this is what's happening. So
your question was related to the Jimmy Carter Act, right? where you.
No, he wanted to say it's like, okay, maybe if they go too far, you create a bubble, but if you do it in the right way, you create a balance and you put people in the economy, right?
Yeah, it's kind of reinvestment rate, isn't it? All I was saying was like, if you don't do something and you let just the banks set exchange rates without any help from government, without any help, it means that okay, they're going to do their risk and they're only going to serve like the slither of people at the top that they know that they can pay back, which means that all the people underneath that are like excluded from that service.
But you saw that the people at the top did not pay back at all. So the prime loan market, they had a lot of foreclosures. The foreclosure rate for the prime loans were bigger than for the subprime loans. Mm-hmm. So it's not only the poor people who would get into the economy if you give them money. It's everybody. It's this bubble. It's this relaxation of lending standards that the government is forcing on the banks. Yeah. And just to finish. Okay, this was 2008. I would like to make another presentation about from 2008 till today, and there's another bubble going on, and I will tell you what is happening and how you can profit from it. So, yeah. No, but where you must put your money to get rich.
ESADE. Did it already.
Okay.